Welcome to the Local Real Estate Show. Join us each week as we hear from local real estate professionals from around the country. We'll hear their stories, get their advice on the current market trends to the best ways to get the most out of your real estate purchases, sales, or investments. Whether you're just getting started and buying your first home or you are a seasoned real estate investor, there's something here for everyone. So buckle up and get ready to hear from the people who know the real estate industry the best. Now your host, Steve Champagne.
Hey everybody, welcome to the show. Today I have a special guest. We'll be talking mortgages with Travis Scott of the Mortgage Brewers. Welcome to the show, Travis. How you doing?
Thank you. I'm doing well. Thank you for having me.
Glad you could be on the show. So, all right, let's get right in it. So I have a few opening questions I want to get with you. And first of all, why don't you tell me a little bit about yourself?
Sure. Well, again, Travis Scott, the Mortgage Brewer is my brand. I work for Trinity Oaks Mortgage and been doing loans for a long time. So 21 years, long time, graduated on a Saturday from the University of North Texas and started on a Monday in the mortgage business. So this is all I've ever done. I live here in the Denton, Texas area, but we service all over Texas. I'm licensed all over and have a wife. We've been married 22 years, 6 kids, 1 grandbaby. And so, yeah, it's pretty good, pretty busy.
6 kids. Okay. How was that raising 6 children?
Pretty loud and a little smelly. But overall, it's been a blast. I mean, when you go from man to man to zone defense, you just kind of watch the perimeter, make sure no one leaves or bleeds, and you're good to go. So
I like the analogy of football, raising your family. How old's your oldest and how old is your youngest?
Yeah, my oldest, she's 21, and then my youngest is 12.
Okay,
So,
all right,
yeah.
all ranges. So you briefly mentioned you've been doing loans for over 21 years. How's that treated you?
It's been great. It's been a good profession. It's been very flexible. Obviously, with my schedule, I need to be flexible. So that's been fantastic. I mean, the commission-only world it can be awesome. Some months can be very stressful, but overall, it's been a great industry to be in. And you met some really cool people, and helping people get into their homes or make that first purchase or their 7th purchase or invest or restructure debt and save thousands of dollars in cash flow a month. That's a huge win. And so, I do love being a part of that transaction for somebody.
So I'm seeing in the background of your video feed, the Mortgage Brewer. You're one of the few mortgage professionals that I've interviewed that actually has their own brand. Let's talk a little bit about that brand.
Well, yeah. So I've been brewing beer for, I don't know, maybe about 10 years as it's a hobby at my house.
Okay.
And I guess it was back in 2019, kind of came to the realization that I wanted to marry the brand, a hobby, and my profession into a brand. Okay. And I was actually listening to a podcast about branding, and that's what they said to do. So I was like, well, the first thing that popped in my head was the Mortgage Brewer. And, so I brew beer and craft home loans, or we brew the perfect mortgage. And quite honestly, my whole philosophy in business is to create an environment where, we can be relaxed and raise a glass and share life. I think everything that's important in life, everything we work for, that we live for, it all happens in that ping of the glass with somebody across from the table. So being able to create that space it's my philosophy in business. And so it's allowed me to do that. So yeah, I brew beer, and people get 6-packs at closing of beer that I made for them, or I do a lot of title company events or realtor events where I can bring and just, again, create the space where we can fellowship and build relationships. So okay,
great. So it's working for you.
Yeah, it's working for me. I mean, I don't know of anybody else that does that, and it's been a lot of fun. It's a great conversation piece. I think it just takes the walls down. I don't buy leads, or I don't pay to play for business. So it's all about relationships and referrals. And so having that environment and that philosophy has helped me to make, greater relationships and go a little bit deeper and more on a personal level.
Okay. All right. So let's start diving into mortgages. All right. Mortgage rates have been down in the 2s and 3s just a year or so ago, and we're in the 7s now. Where do you see mortgage rates going, or the mortgage market in the next year or so?
Yeah, great question. Of course, if I knew that, I'd have my own island. But I think for the most part, we're hopefully on the trajectory downwards. We'll probably see a little bit of a up and down as we go, but the general trajectory of rates as we go deeper into this recession should help out. I mean, if you look back all the way to the 50s, and every recession we've had, every single one, we've had interest rates fall, which, so historically, that's all we have to go on, and that should happen again. When that does, whether it be 6 months, 12 months, we should, people are actually saying, people we follow are saying that we could expect that in the summertime, that maybe we dip back down to the 5s. I think it's a real healthy spot to be. I think, I don't know that we're going to see the 3s again. If we do, then something terrible is going to happen in our world, because usually when the stock market struggles and things happen, our rates get better, which is kind of a double. You don't want that to happen, but we also want that to happen.
It's a double-edged sword.
Yeah, for sure. So I think, in the next few months, we'll see some relief in our end, and that's going to create another buyer frenzy and, probably another multiple offer situation.
Very good. All right. So a lot of people that are watching this interview will be first-time home buyers. So I like to go through a series of questions related to mortgages. And so the first question I have for you is, what is a conventional mortgage? What is it?
Yeah. Conventional mortgage is pretty much any loan that is not backed by the government, whether it's an FHA loan or the Federal Housing Administration or the Veterans Affairs, the VA loan, or a USDA loan. Those are all government loans. So a conventional loan is anything that's not that. And they're run by private entities, Fannie Mae, Freddie Mac, and even some non-QM stuff, which is the old subprime world, right? Where we can do off the wall type of transactions for people. So conventional is a great loan. I mean, it's really the best for the best credit situation, and there's other benefits, but the government loans too are very strong programs.
Okay, which brings me, we briefly talked about, you mentioned FHA. So what is an FHA loan?
So an FHA loan it's guaranteed by the government. It's the Federal Housing Administration. They have this program, and it's really meant for low down payment loans. If you have blemished credit, it's a great program because the pricing is very forgiving when it comes to interest rates and lower credit scores. Yeah, it's as little as 3.5% down. You can have more in seller paid contributions than you can on some conventional loans. So it's a really good way for people that are starting out, maybe don't have a lot of credit established, or maybe they've had some blemishes in the past, for them to be able to get into housing at a very affordable rate and low down payment.
Do you typically see yourself putting first-time home buyers in this type of program?
We always explore it. We always do. But, if the credit is high enough, there are some low down payment conventional options as well. And so we'll give them all the information so that they can make the best decision for their family.
Okay. Probably a question is, how much of a down payment do I need? You typically hear 20%, after the whole 2008 debacle, banks are saying 20% down. Where are we at right now with down payments when it comes to mortgages for first-time home buyers?
Yeah, it's a great question. Conventional with the first-time buyer, if you qualify, you can actually do as little as 3% down. Okay. 5% down is also a pretty common area to land. If maybe you're buying your second home, or you've bought and sold, 5% down would be the least available. And then if you're doing an FHA loan, it's 3.5%. But if you're a veteran and you wanted to use your VA benefits, that's the best loan in the market, period. Okay. And it's zero down. There's no monthly PMI. If you do have any disability from the military, you can be exempt from the VA funding fee. So it's a great product. And then, of course, there's also USDA, which is another government loan that's for rural areas. It's going to be zero down if you qualify for it. So there are options, low down payment options for first-time buyers for sure.
Okay. You just mentioned PMI, and that was my next question. So what is PMI insurance for the person that's watching this interview today?
Yeah.
What is it?
PMI is private mortgage insurance, and that is basically an insurance premium or policy that the the borrower takes out against for the lender in case you default. So you're putting down less than 20%, you're required to pay PMI, and that again protects the lender against the borrower defaulting.
Mhm.
There's several ways to skin that cat. You can either pay it monthly, you can pay it what's called lender paid PMI, where it's basically built into the rate. You can
Mhm.
also pay it upfront in cash.
Okay.
You can also finance it, so you can stack it on top of your loan amount and finance the PMI that way. But if you have 20% equity on a conventional loan, that's when the PMI can go away.
Mhm.
And so, typically if you're putting down 3 to 5%, it may take you a few years to get to that 20% equity. And then the
Mhm.
PMI should be dropped off your payment. You can always request it from the lender that has your loan. However, on an on an FHA loan, it's very important for people to know this, that the PMI will last forever. It will last for the life of the loan, regardless of how much equity you obtain. So if you are wanting to get rid of that and you're still in that home, you just want to refinance that loan into a conventional loan when you're at 20% equity, and then you can get rid of that PMI.
Basically, you've answered my next question, which is how long do I need to carry
Oh,
PMI?
yes.
No worries. All right, let's move on. All right, so people are wondering, okay, so what are my closing costs? So what are the typical closing costs associated for a buyer when it comes to mortgages? What are their closing costs?
Yeah, I would say, on average, you're going to pay anywhere between say $3,000 to $5,000 in fees, whether that's
Mhm.
closing costs with the lender, you have your estimated title fees, you
Mhm.
have third-party fees like credit report, appraisal,
Mhm.
verifications and things like that. I'd say on average between 3 and 5,000 for your closing costs. But you also have prepaids, and those are your taxes and insurance. So we have to collect if you're going to have taxes and insurance a part of your monthly payment, which a lot of people do.
Mhm. Can't hear you.
Sorry, excuse me. Uh, typically, first-time buyers will have taxes and insurance in your payment,
Okay.
and so if you do that, we have to collect 15 months of homeowners insurance in at closing, right? A full year's worth of insurance plus a 3-month cushion, and
Yep.
then 3 months of your property taxes. That's called an escrow account.
Okay.
And so that could be another $2,000 to $4,000 depending on the size of the house and the taxes. So you add those two together. I mean, you can run between $4,000 and $8,000 in cash.
Above and beyond your typical closing costs.
Well, that would be include, yeah, and everything. And
Okay.
then of course you have your down payment. Now you can have your realtors negotiate for the seller to cover some of those closing costs. And that's happening a lot right now in this market, which is really nice. So we're kind of back to the seller participating and helping those buyers,
I can
cover
see.
some of those costs. Yeah.
All right. So documentation is needed to get a mortgage. So what is the typical documentation for someone who has a job, right?
Yeah, W-2. Yeah, back in the day, as you mentioned, prior to the crash, you could fog a mirror and get 100% financing and not even have a job or assets or anything. It was crazy.
Mhm.
So yes, we do have to verify that you make money and that you have money. So we
Mhm.
will typically look for 30 days of pay stubs, a year or two of W-2s, and then
Mhm.
30 days of bank statements to verify where the money is coming from.
Mhm.
That's usually the standard when it comes to W-2 employee. Now,
Mhm.
if you are, overtime or commission or things like that, there may be a few other documents, but that's pretty standard.
Which leads me to the next question, I should say, is what documentation do you need if you're a self-employed person such as ourselves? What type of
Yeah,
documents do you?
right. Yeah. So it can be a little bit more tricky for self-employed for sure. If you're going to do what's considered a traditional loan or a full doc loan, we
Mhm.
would look at your tax returns for the last 2 years, your last 2 years of filed tax returns.
Okay.
For your self-employment. Then we take the net of the income. So you could have a really good CPA and you could make $400,000 a year in gross revenue, but only show $30,000 in net. I
Mhm.
have to use the $30,000 in net. So you have to be, real careful on how much you're writing off because again, we're going to go off the net income. There are other programs out there that are as I mentioned previously, non-QM loans, where we can average bank statement deposits to figure out self-employment income. Those type of loans will come at a higher price, as far as the rate goes. But for a standard loan, it's usually 2 years of tax returns with the average net income.
And if that is not enough, you're saying then you can then look at 2 years worth of bank statements and come up with an average income off of those bank statements. Is that correct?
Yeah, there's some that are actually even only a year with bank statements. But yes, that would be the second option would be to average your deposits and see if we can use that.
Okay. All right. So there's this term that gets thrown around, and I think it's pretty confusing for someone who's particularly buying their first home. This thing called debt to income ratio. First of all, what is it?
Debt to income ratio would be basically the amount of your debts. It's a percentage that we look at. It's the amount of your debt payments, including the new mortgage, into your usable income for the month. And so a threshold that we like to be at is about 45%. Even sometimes up to 50%. So for just math purposes, if you had $10,000 in usable income for your household, maybe you and a spouse, are working, we can say use $5,000 of that. So out of that $5,000, you subtract all of your payments, like your student loan pay, all your consumer debt. So student loan, car payments, credit card payments, not your utilities, but your actual consumer debt payments, plus the new mortgage. And then that's what you would qualify for. So let's, if you had $5,000 to work with and you had $2,500 in car loans and student loans and credit cards and things like that leaves $2,500 for a new mortgage payment. That's what you would qualify for.
Okay. What is the ideal debt to income ratio? There's a front number and a back number.
Yeah, front end. I mean, I've seen some anywhere in the 30s. 30%, 35. If you're under 45, that's pretty solid for the back end. So the front end is just your house. It's just your housing payment into your income, and then the back end is all of your debts plus the house. So if you're 30 to 45, 30 front end, 45 back end, that's a pretty sweet spot to be. There are some programs that can be a little bit more aggressive. I know FHA can actually go up to 55 on the back if your credit scores are high enough. And so that's helped a lot of buyers have a little bit more buying power. Now, of course, you got to be real careful. You don't want somebody to be house poor. So you want to make sure we consult with them and say, okay, can you afford this? Because we're going off a gross income on W-2.
Yeah.
So we don't go off the take home. So you want to make sure that they understand that, they don't want to be house poor when they move into this place.
All right. So there's another number out there that's important when it comes to getting a mortgage, and that is the FICO score. Can you go and explain to our viewers what is a FICO score and how it works when it comes to getting a home loan and a mortgage?
Yep. So FICO score, the kind of easiest way I can say it is a credit score is a reflection of how you pay your debts. So if you don't have any debt, then you have no scores. If you have bad debts and you don't pay your bills very well, you're going to have a low credit score. Obviously, higher credit score or higher payment history, good payment history, the higher the scores. It's very important in our world because everything is based off of it. Programs, as far as your eligibility, can be determined if you have too low of a score, you just don't qualify for any financing. Or there are tiers in pricing. So believe it or not, there's a difference in interest rate between a 719 and a 720. Okay. And it can be pretty substantial. So the higher, if you're above that next tier, then you're in, great pricing for the next tier up. But it's very important. People say a lot of times, well, I'll go to Credit Karma or something like that, and I know my credit score. I have just fair warning that places like Credit Karma and those consumer websites, they're very good for monitoring activity. They're very bad for knowing your credit score. They use a completely different algorithm and a FICO scoring system than what lenders use. So typically, something like a Credit Karma is going to be about 20 to 40 points higher than what I'm seeing. Okay. Because again, they grade things differently. It's a whole different algorithm of how they come up with their credit scores.
Which leads me to, there are 3 bureaus, right? And you're taking the middle score of those bureaus, correct?
Yes. Yeah. We'll take the middle of the 3. And then if you have multiple borrowers, the lowest middle is the grading score.
Okay. All right. So how will my credit score affect my eligibility? You briefly touched on it, but can you go a little bit deeper in that? As far as you said, 720 would give you one rate, 719 would give you another rate. What is the bottom FICO score that you should be looking to maybe get into the market and buying a house? What's the range?
Yeah. Well, there are some lenders that can go really, really low on some, FHA products. I mean, down in the mid 500s.
Mm-hmm.
I would say, technically, yes, we can go to 580.
Mm-hmm.
But if I can work with you to massage your credit scores to get you above 600 or even above 620, then the world changes for you, because the pricing is so much better. The costs are so much less if you can just get, the 20 or 40 points added to your score. There are down payment assistance programs out there, but that have a starting credit score that can, if you don't have it, then you're not eligible for those programs. Or, not even, same thing with like USDA or conventional. You need to really be in the 700s for good pricing on conventional. We can do them lower than that, but you're going to start to pay higher in rates and fees if your scores are lower. So it matters. It's huge. Credit score and debt ratio are the two biggest factors that we have, in trying to get somebody approved.
Okay. Well, that kind of wraps up the Q&A portion of the interview around mortgages. We're getting close to wrapping up this interview, and I got just two more questions for you. I ask this one of everyone that comes on the show, and this is, why should someone work with you versus your competition?
That's a fair question. All I can say is, for me, I've been doing this a long time. As I mentioned earlier, I don't buy leads or, pay to play or things like that. For me, it's all about the relationship. So my customers, it's not just a transaction for me. It's my lifeblood. So my referrals, my database is how I grow my business.
Okay.
Rates are rates, fees are fees. We're in the market, we're competitive. Otherwise I wouldn't have a job. So I'm not going to ever tell somebody that I'm the lowest rate, come see me. We're going to be very competitive, but there's always somebody on the internet somewhere that's going to do something cheaper. That's just the nature of what we do. But I will tell you that, having been doing this for over 20 years, being accessible, being local here in North Texas area, and being, someone that they can fully confide in and trust. That's how I built my business. And that I think would separate me from, an online lender that may just be an order taker. We're going to provide the information and advise them on what they should do and give them options. So again, so they can make the best decision for their family.
Okay. Well, Travis, thanks for coming on the show. If someone wants to get a hold of you, what's the best way they can get a hold of you?
First of all, I would say my website is very easy to remember. It's just mortgagebrewer.com.
Okay.
They have all my contact information there. If you're on any of the socials, you can just search the Mortgage Brewer. You'll find me.
Okay.
YouTube, LinkedIn, Facebook, all the stuff. And then of course my phone number. I think you've got it scrolling down here at the bottom. So, again, anyway, social media is probably the easiest way to find me. And then you can always send me a direct message. That's fine.
Very good. Well, Travis, thanks for being on the show. Everyone, until the next time, make it a great day. Take care. Bye.
Thanks.
You have been listening to the Local Real Estate Show. If you are a real estate agent, a mortgage broker, or a closing company and would like to be a guest on an upcoming show, please visit thelocalrealestateshow.com for more information. Thanks for listening.